Okay, so today we're talking about funds, ETFs, mutual funds, and bonds. So let's start with ETFs. When you're investing in an ETF, you buy a wide variety of securities. It can include bonds, it doesn't have to necessarily, but the amount of security being held by an ETF varies, so they're not all the same. Also, there's fees included, management fees and other fees are included. The way you make money on an ETF is by the increase in price and also with dividends. So those are the two ways you make money with them. It's a safer way of investing because it includes really great diversification in your portfolio. And you can track the overall stock market, you can track technology, pharmaceutical, you can track currency or the real estate market. So it's pretty cool. So when you're investing into an ETF, you own fractions of the securities that's being held in the ETF. So it's pretty cool. So mutual funds. Mutual funds is also a basket of investments, and it includes well diversification. Mutual funds are professional managed, and so they have a little bit higher fees. Also with mutual funds, they trade or they get updated every night at market closing. So they don't move like ETFs and stocks do, where you can watch the price go up and down during the day. They're actually updated every night at market closing. Also, mutual funds, yeah, they have a little bit higher fees. You can't just buy a share of a mutual fund, so that's impossible. You have to, it's a certain amount, and it varies from mutual fund to mutual fund, how much that is. So it varies your investment, but there's a certain set of investment you have to pay in order to purchase a mutual fund. So the prospectus gives the investor details about the fund. There is a minimum investment amount, which can vary from fund to fund. The benefit of any fund is diversification. This can help to lower risk. Possible fees on a mutual funds are management fees, transaction fees, and sales loads. So the way you profit from a mutual fund is by appreciation, just like with an ETF, and by dividends. And so there's a wide variety of mutual funds, like equity funds, buy stocks, fixed income funds, buy bonds, and balanced funds have both stocks and bonds. So a bond is totally different. A bond is a loan that you're giving to a company or the government. So by issuing a bond, a company borrows money from investors to either grow the company, pay for debt, or finance new projects. But the investor profits from a bond by interest payment, and eventually the principal is being paid back to the investor. So bonds are less risky than stock. They are sometimes used to diversify a portfolio. The investor receives regular investment payment, and original investment is returned after the maturity date. Characteristics are regular scheduled payments, return of investment principal. The risk is that the issuer could default in paying back the principal or goes bankrupt. So the safest bonds are probably government bonds. They're known to pay back their loans and to pay back the principal. However, there is companies that are called rating companies. And you can look at rating companies and how they rate a company. Like if you think about it, Nike issues bonds. A lot of companies issue bonds. I don't think any of those companies will default on their bonds. However, if you're really worried about it, then I would say probably government bonds are the safest to go with. But look up the rating companies and see how they rate the different bonds before you invest in any of them, and see how that helps with diversifying your portfolio. Anyway, so I hope you like this video, and please give me a thumbs up, and I will see you in the next video. Thank you so much. This is Claudia. Bye.